Hi guys, and welcome back to another episode of What's on Your Mind. I've got Jason McDonald and Raj Malhotra joining me on the call today. Guys, it's always great to have you on the call. Um, I think we'll dive straight in today. And Jason, it's been a little while since you were last on What's on Your Mind, so we'll start with you to kick things off. Have you spotted any interesting ideas for your portfolio over the last few weeks?
Yeah, I mean, I actually along with a lot of other experienced people that I know, it's quite an interesting market at the moment, and I think it's fair to say that for most people, they're not really sure which way it's going to move next. As we've seen, there's a lot of kind of toing and froing and up and down, but on an intraday basis. But then if you look at it over a sort of longer period, it looks like there's nothing happening when actually there's a lot happening within the market in terms of rotations and stuff. And obviously, we've said on here before, we've talked about the kind of reopening trades versus, the tech stuff. And, it kind of continues to churn away. So it's actually, I'm really market neutral at the moment, but I have actually bought a stock recently. In fact, this week. So for a change, I'm going to talk about a UK stock. So its market cap is $3 billion. It's called Redrow PLC, tickers RDW.L. Share price is 6.25. That's where I'm in around these levels. So what do they do? It's a very easy business to understand. It's a UK residential housing developer. So, for the guys out in America, if you think of sort of along the lines of Lennar, for example, LEN, you'll get the picture. These guys are UK, so they're building homes across England and Wales. They're a house building company. Their product range is kind of traditional family housing in the regions. And then in London, in the bigger cities, they tend to build apartment schemes. For those of you that might be familiar with the company, their brands are the famous brands that they own are Heritage Collection, Regent Collection, Abode Collection, and Bespoke Collection. So just to talk about the quantitative side of things first. So their EPS for F0, so reported for last year, was 32.8p per share. The consensus forecast for their F1 EPS is 64.82p, and the consensus F2 EPS forecast is for 72.44 pence. That equates to earnings growth this year, so F1, of 98%. And we'll talk a little bit about that, which obviously, sounds like a large growth rate. Of course it is. And EG2, so earnings growth for F2 is a more kind of normalized 12%. And the company is on, it's on basically a sector average P rating. It's at a small discount to the sector for this year for F1, and it's on a sector rating for next year. So the PE for this year, F1, is 10 times, and for next year is 9 times. These are kind of fairly standard multiples for house builders. And that compares to the sector average PE, which is 11.8 for this year and 9 for next year. In terms of the earnings growth numbers for the sector, as we've seen with US house builders, there's a big bounce back taking place this year. So earnings growth average for the sector this year is 61% versus 98% for Redrow, and earnings growth predicted for next year for the sector of 9% versus 12% for Redrow. So on that basis, the company is obviously predicted to be outperforming the sector. In terms of the qualitative aspects of the trade idea, so just to give you a few facts, back in 2019, which is kind of like the last, normalized year, UK house builders essentially completed 170,000 houses. That compares to household formation that year of around 230,000. So clearly there's a deficit there. And in fact, the current deficit, which has been built up over the last decade of undersupply of housing in the UK, is about 1 million houses, which is obviously a significant number. And that's, I think, why sometimes you see UK house prices kind of confusing maybe external observers, and who might be expecting UK house prices to fall, which is predicted quite a lot. But this fundamental demand supply imbalance is there as an underlying feature for the last decade, and that's why you don't see UK house prices falling very often. So specifically, with respect to their last full-year report, they built in the last financial year 4,000 houses, just over, which was a 37% drop from 2019. I think we understand why. That caused a similar drop in revenues, so 37% to £1.3 billion. Nevertheless, even with a revenue drop of that size, they were still profitable last year, generating £113 million of net income. Now, in terms of the qualitative reasons as to why I think this is a good purchase here, I think that apart from the fundamental demand-supply imbalance, I think also there is demand in the UK, particularly for red rose type of product, which tends to be higher end, higher quality family homes in good commuter areas with outside space. And what we've seen is property in those types of areas has remained with a very strong bid during the pandemic. It's exactly the kind of things that people are looking for. So further out with outdoor space, larger homes. It's kind of like a post-COVID desire for people. In terms of the company's size, it's a $3 billion market cap company, so it does have economies of scale and it does make decent returns on capital, but it's also small enough, unlike some of their larger competitors, that it will still, over the next 5 years, be experiencing very healthy growth. So I think they're kind of in a sweet spot from that perspective. Financially, they've generated over the last 5 years leading up to end 2019 financial year, they've generated very high returns on capital, on average 19%, which is really good. At the moment, they're only trading on 1.3 times book value, which is how you tend to look at the house builders, which is very undemanding. And I think that they're going to return to generating that kind of superior return on capital this year. The balance sheet is conservative as well. It's not overladen with debt. As of the last full-year report, they had net debt of £126 million, which was even on last year's grossly reduced EBITDA number, was only 0.8 times EBITDA. If we look at it relative to predicted EBITDA for this year, that's only 0.4 times. Now, they've got some other liabilities relating to land development to the tune of about £300 million. Even if we add that into the net debt number, that puts them on 2.8 times last year's much reduced EBITDA and 1.5 times F1's EBITDA, which is, again, this is very conservative. And, in terms of like completing the kind of the bull arguments for me, just to quote from the company's chairman on the last earnings call, he had this to say: "We emerged from the lockdown in a position of strength with a record order book and high levels of work in progress. We've also seen resilient post-lockdown demand fueled by the learning changes to the Help to Buy scheme, which is, in brackets, that's a government scheme over here to help people purchase properties, and the stamp duty holiday. As a result, in the first 11 weeks of the financial year, reservations by value are 12% ahead of last year, and reservations per outlet are particularly strong." So for those of you who don't know the UK landscape, Help to Buy and stamp duty holidays are a feature of government incentives to get people buying properties. In terms of catalysts for this, well, at the beginning of this month, the stamp duty holiday was extended as a government fiscal incentive to encourage purchases, and my hunch is that that will continue to get extended, and that's the catalyst that I'm looking for going forward. And obviously around the general kind of theme of the UK economy reopening. There isn't really any choice in terms of how you express this trade. There are no single stock listed options on the company, so you've basically got to buy stock or CFDs or whatever. So as I say, I've gone long the stock at 6.25. My target price over the next 3 to 4 months is over £7.50.
Yeah, I absolutely agree with you on kind of this the moving of people to those sorts of houses, and of course I also think that they'll keep extending stamp duty and things like that to support the housing market here. That just seems, it's been going on for a while already. It seems like it's just going to continue. So yeah, cool. Thanks for that, Jason. Raj, let's go over to you. What about stocks that you've been looking at?
Yeah, so kind of like Jason, what I've been looking at, I've been really looking away from the explosive growth tech sector, just because given what's been going on, I've been looking at companies with real profits and something defensive, because I am a bit market neutral, like Jason said, but I do still want growth within quote unquote value stocks. So I don't think it's either market right there, but that's really where I've been looking to really find value and opportunity here. So one name that caught my eye that I have a position on is a company called Darling Ingredients, DAR. Now, this is a company that's way off most people's radar, and I think that's why there is a lot of opportunity on this. This company basically turns animal byproducts into profits. So clearly, this is not the most exciting business, and clearly not the type of company that most people are dying to own. But in this market, that's what I like, and I like the way it's been trading. And I really think that once more people look into a company like this, this is the kind of company where there's real opportunities going forward. And I'll go through some of the reasons. But in terms of the earnings, let's talk about that first. Their next earnings report is scheduled for June 1st. They're expected to make 56 cents, and their revenues are expected to be around $970 million. So they're expected to make about $1 billion per quarter. So if you look at their March report, they reported 45 cents versus an estimate of 42 cents. So even quarter to quarter, they're expecting 11 cents higher. And they made about $1 billion that quarter, which was well above their $900 million estimate. So if you look back in terms of their full year earnings, in 2020 they made $1.91. In 2021 they're expected to make $2.40. So a pretty big increase there. But really, the big number is in 2022 they're expected to make $3.95. And I'll go into a little bit why I expect it to be so high. Because normally I wouldn't normally care about next year's earnings so much while we're still in Q1, but there's a real catalyst that's going to happen at the end of next year. So I really want to highlight why 2022 is a big number for them, and some of the reasons why going forward. So if you look at the analyst estimates, the stock's trading around $70 right here. I initiated a bigger position. I added to my position earlier this week when the stock dipped below 70. But the average analyst estimate is $85, with as high as a 94. And I really think that there's upside just from those numbers. And I think they're being a little conservative. In terms of comps, it's hard to compare this to other companies in their sector because it's really in the biodiesel production market and with animal byproducts, there's really not a lot of comps. This is not exactly like I said, a sector that everybody wants to get into. And there's so many companies just fighting for this market share. And since they are a market leader, a lot of their competitors are also too small to really compare. But having said that, I do think that does create an opportunity for this company, given the fact that there can be M&A in this sector. In terms of catalysts, in Q4, they reported record biofuel diesel production. Their company clearly benefited from higher commodity prices, and in particular, the demand for renewable diesel. And as the economy opens up again, this demand should clearly ramp up. And obviously, another obvious catalyst that could be come later this year or early next year is the infrastructure bill. Depending on how much Biden's able to pass, all that big machinery is a lot of it's run by diesel. So there's a big potential upside for this company should that pass. And obviously, as a market leader, there's no way that they wouldn't be able to participate. So the main thing in terms of 2022 is they have a facility expansion, which is going to be completed by year end. So basically that facility, which is a joint venture with Valero. The earnings are just from that. Like I said, they're expect to go from $2.40 to $3.90, and that market they should have something about 80% of the market share in just biodiesel production. So obviously the long-term growths are strong, and like I said, with that extra money, they could just swallow up the competition. Again, bionutrients aren't it's not very glamorous, but they do have a lot of other sectors or a lot of uses that you may not know about. One is clearly livestock for pet feed. Another one is that they're in the pharma business. Their blood plasma can be used in pharma and in collagen. And like I said, the main driver is that biodiesel production, and I really think that that's the part of the company that's really exciting, and it's delivering real growth in a company that's trading at a multiple which trades in line with value, and companies that, quite honestly, if you look further rather than just in like this specific sector, if you look out broader across the industrial complex, or in sort of the industrial stocks, a lot of those companies are trading on a hope of a rebound. This company actually was year over year higher in every financial metric, and they should expect to be the same in 2021 and the same in 2022. And there's very few industrial companies you can say that about. So in terms of the bottom line the stock it's rallied about 20% this year alone, but it's had a little bit of a pullback given all the small caps in the last week have had a run into some headwinds. So I think that's created opportunity. And the main thing is, again, with all the strong trends in agricultural, in ags and commodities, and really it doesn't even have the multiple of a renewable energy company, which the market at some point may give them that. So, looking a year forward, could the stock could be up 100% if everything goes according to form. But conservatively, even a 15% year-over-year growth this year and revenue rising should easily get the company, in my opinion, by mid-year, probably up to $90 by their next earnings cycle, by their next earnings quarter. So in terms of structuring, with the stock around $70 right here, I was looking at the July 70 calls. I initiated when the stock was below 70, but even when I looked at it yesterday, the July 70 calls were trading for around $7.50. And like I said, I think the stock could easily get above $90 by July expiration, given that they have earnings and the other potential, the potential announcement of a stimulus bill and more economy, with the economy reopening, will start to get industrial projects moved. But in terms of, I was looking at potentially selling the May 80 calls against them. The May 80 calls are worth $2. I think that the market will have some short-term headwinds. So I think that there's a good chance that the stock stays below 80 by May, which is right around their all-time high. So if you look at on that spread by collecting $2 versus on the Mays versus the $7.50 that you pay in July, if it stays below 80 by May, but it goes above 90 by July, you should get more than a 3-to-1 payoff. I actually like this even more so if you do this as a ratio spread, or possibly if you want to sell a little bit more juice, you can sell the May 75 calls, which are trading around about $3.30. But either way, I like selling some May calls against that those July 70 calls. Not only for the reason I said, this doesn't even take into the fact that the valuation here is not only very reasonable, the market's not actually looking yet at the fact that the company's actually deleveraging and their margins are firming up. So that really is another thing that the company could say in their next earnings report, which the market's not really talking about yet. And given the fact, like I said, it's not a very exciting company, the market is unlikely to realize that between May and July, unless the company just comes out and says it. And this is not a company that's very much in the news. So for all those reasons, I really like the structure, and I really think there's a lot of upside, and not only on the stock, but on the specific structure.
Yeah, that's definitely an interesting structure to kind of take advantage of that sort of thesis as you outlaid it there. Jason, let's go back to you. We've talked about a couple of longs. Do you have any short ideas you wanted to mention?
I came up with one actually in the last week, which hasn't moved that much in the last week, so it's still there as a trade to do. So ticker is DUK. It's Duke Energy. Now I want to talk about the macro top down first before I talk about the actual company itself. So as everyone's seen, we've been watching U.S. Treasury market yields going up. For example, the 10-year U.S. Treasury is now yielding around 1.69%. That was around 1% at the end of last year, and as low as 0.5% in the last 52 weeks. So, I'm not sort of a rocket scientist here, just thinking about what suffers in a rising rate environment, rather than what we can profit from. We know what we can profit from. Obviously, this is great for the financials. The banks finally have got a bid to them. So, what suffers? What tends to suffer in a gently rising interest rate environment? So that's the key here. The rates are gently going up, as opposed to a big sort of shock to the system. So what suffers in this type of environment is long duration assets, especially ones without pricing power. And the longer the duration, the better. So when you've seen the rotation out of the Nasdaq stocks, out of tech, as yields have been going up, particularly on the 10-year, what people really meant by that was actually high PE companies. And why might that be the case? It's because of the way that analysts come to their valuations on stocks and companies. So there's something called terminal value, which is a large component of how analysts come to a present day valuation on stocks. And what happens is that as market interest rates, so what you need to be aware of here is what's happening to market interest rates rather than what the Fed is doing. So as market interest rates increase, the analysts have to increase the discount rates that they're using on the future cash flows that they're discounting back over multi-year time horizons to a value in the present. So having said that, my short is clearly not a tech company, because although I understand why and see that the case as to why these long duration, high PE, high growth assets would come off in the short term, a lot of these guys have pricing power. They are not necessarily monopolists, but they have pricing power within their markets. So what I was looking for was a sector that has headwinds from rising rates, but also doesn't have pricing power. And so that's where utilities come in. So I chose Duke Energy, DUK. So why would I choose a utility? Because most of what utilities do falls into what are known as regulated activities, which means that the industry regulators basically decide the maximum that these guys can charge to their customers. So Duke, market cap $71 billion. It's got a PE rating, F1 17.8 times versus average for the sector 18.8. PE for F2 of 16.9 times versus 17.7 times for the sector. So clearly trading at a discount to the sector. Earnings growth F1 is anemic. It's 1.75% compared to 4.6% average for the sector. Earnings growth F2, 5%, so a little better compared to the sector F2 average of 6%. Now, where these guys slightly outperform is they've got a dividend yield of just over 4%, 4.2%. Average dividend yield in the sector is 3.5%. Now, to be clear here, if you short the stock, you're going to pay away the dividend. So if you were short for 1 year, you'd end up paying away 4.2%. I don't aim to be short of this for a year. So just a bit of background on the company itself. 91% of their revenues last year came from electric utilities infrastructure, where they are essentially in the electric transmission business. And that is mainly in Florida, the Midwest, and the Carolinas. So that was 91% of their revenues. That segment, they can't decide what they charge. It's regulated. Okay, 7% of last year's revenues came from gas utilities and infrastructure. That's mainly natural gas distribution in Ohio and Kentucky, and a bit of natural gas storage. And then 2% falls into commercial renewables, which is primarily a non-regulated wind and solar generation assets business. So qualitatively, I see it as a low risk market hedge in a rising rate environment. In addition, peculiar to this company, they've already been getting downgraded by the debt ratings agencies. So last October, they were downgraded from a stable to negative outlook by Moody's. Their financials don't look particularly great. They've got a current ratio, which is your ratio of current assets to current liabilities, of 0.53. Anything less than 1 is always a bit concerning, so 0.53 is pretty pathetic. Their interest coverage ratio, as of end of last year, which is the last full year that we've got, was 1.4. So put that into context, anything below 2 is again, not particularly impressive. And that's come down over the course of last year from 1.9 to 1.4. That's the interest coverage ratio. And rather importantly, these guys, their cash flow from operations does not cover their investing activities. So they need to reinvest a certain amount of capital, obviously, to maintain the networks, etc. Their cash flow from operations doesn't cover that. So they are cash flow negative. They are effectively borrowing to pay their dividend, which is, not a great situation. Again, their return on invested capital is 2.6%, which is appallingly low, and does not cover their, exceptionally low cost of capital, which in this environment, their cost of capital is only 3.3%, I've worked out, but their ROIC, their return on invested capital, is 2.6%. So it's a value destructive business. Potential catalysts, well, really it's more a continuation of the theme of, further increases in the US Treasury yields, particularly the 10-year, will help this as a short. But also, I kind of throw it out there as a potential catalyst. I'm not sure on the delta of this. It's probably relatively low delta. But if these guys were to cut their dividend, then I think, you've just basically taken away the kind of last support as an investor for the stock, really. So the trade structure, I had a look at the options market. And actually, given what Raj has just said, maybe I should have looked at calendars. So I've been a little bit remiss there, but I just looked at some basic put spreads. And really, I couldn't get to anything particularly attractive. The best thing I could find was a July put spread, which is where you go long the 92.5. The stock's currently around 94.5, 95. So this would be, you go long the 92.5 for July, short the 85s. On mid to last prices, that's going to cost you around $2.10 per contract. To make $5.40, it's definitely not the best win-loss ratio we've seen out there on the option side of things. It's around, 2.6 to 1. It's kind of a marginal options trade. So at the moment, I think you're probably better off looking at shorting the stock. Then if the options prices move a little bit, you might be able to that sort of 3 to 1. At the moment, you're looking more at shorting the stock. So to conclude on that, I just see it as a low risk short as a portfolio hedge with the potential for decent absolute return if they had to cut their dividend for some reason.
And Duke's that's always kind of struggled within that industry. So it makes me think that for them to turn things around, well, everyone more than the other companies, it's going to be very hard for them. They've just historically been a pretty bad company.
Yeah.
To their peers.
Yeah, and you can see it through the returns, which are awful.
Raj, let's go back to you. Is there anything that you've been kind of looking at or considering on the short side?
Yeah, so on the short side, it's been very interesting because one thing I always try and look at in terms of trying to structure shorts, especially on a macro level, is what market participants are looking at as a risk to the market. And it's ironic when I was reading the survey, and now the market participants for the whole, their biggest risk in their mind are either rising rates or the bond market throw a tantrum, basically anything involving interest rates. While the second biggest risk to them is the COVID vaccine rollout, and those two responses were swapped last month. So COVID was much higher than interest rates. And then down the chain, they talk about more regulation, higher taxes, and some other things. But what's shocking to me, there was one obvious headwind that no one was discussing, which is geopolitical risk. And that's the first time in probably since 9/11 that no one has, most market participants are not talking about any kind of geopolitical risk as a risk to the market. And that just makes me a little bit wary because, that's always a risk that no one can foresee. And what's interesting now in terms of geopolitical risk, it's not really, it's always been about the Middle East, whether it's terrorism or how it's going to affect oil. But really now, the biggest geopolitical risk clearly is China and Chinese aggression, both within Asia and within the rest of the world. So that's it, so in terms of a lot of the names that I like, it's given me reason to not be in them just because they have potential risk to China and what they could do. So in terms of the shorts that I have, it's been difficult for me to target names on a fundamental basis that are short, because a lot of the names that are short are the names that are the reopening trades. And while I would rather wait to see how this goes before I actually get short in them. So it's been really hard for me to structure shorts, like classic shorts, given that they probably have more tailwinds in the short term. So it's really become a bit of a stock picker's market. And a lot of the shorts I've had are within the same sector where I think there's outperformance on one versus the other. So in terms of a real short, I'm going to I'm just very cautious on a lot of especially the growth names that don't have any real earnings here.
Mm. Yeah. So you're basically looking out for shorts that can maybe take advantage of the geopolitical risk that you think is being undervalued.
Yes. And just in general, I've really taken down my long risk in the portfolio. So I'm actually trying to be a little bit more defensive of my capital, waiting for some dislocation to actually both from the long and the short side.
Yeah. Jason, on your side, we covered a little bit of sort of macro market stuff there. Did you have anything that you wanted to mention?
Yeah, something that caught my eye was so on the back of the $1.9 trillion stimulus bill that has already passed in the US. Goldman Sachs, their economists they're now expecting 8% year-on-year growth in fourth quarter GDP, which is the highest rate we've seen since 1951, which is obviously fairly extraordinary. And of course, the economy is far, far larger these days. So in those days, I think nominal GDP was about $350 billion compared to $21 trillion in 2020. But I think of more interest is that on the back of that $1.9 trillion stimulus, people are going to be receiving a $1,400 check. And a survey that I saw at the end of February from Deutsche Bank asking people, what they were going to do with their stimulus check. The answer that they got was that respondents said that they plan to allocate 37% of their stimulus payout to the stock market, which is obviously, a fairly significant amount of liquidity. And the comment was from the survey, retail sentiment remains positive across the board, regardless of age, income, or when the investor began trading. And retail investors say that they expect to maintain or add to their stock holdings even as the economy continues to reopen. So I think that's of interest. And then just lastly, apart from sticking some of their money into the stock market, I can't really think about that without kind of referencing these things called SPACs, which are special purpose acquisition companies. I'm sure everyone's heard of them. And I just saw some relatively eyebrow raising statistics on those from Barron's, which got their data from Deal Logic. And they were saying that so far this year, and of course we're not even at the end of March yet, there have been 302 IPOs in the US, raising a total of $102 billion. That was up until March the 10th. Now, 80% of those IPOs have been blank check companies, so-called blank check companies, so SPACs. Now, to put that into context, for the whole of last year, the full total for last year was 457 IPOs compared to 302 so far this year, and a raising in total of $168 billion compared to $102 billion already this year. Now, the previous kind of high watermark was back in the tech bubble days in 99, and that was 108 billion. Of course, that was in 1999 money. But what I think was of even more interest was that in 2020's issues, 81% of the IPOs were loss-making. Now, even compared to 1999-2000, that's extraordinary, because in those years, which are seen, as fairly distinguished years, that percentage of unprofitable issues was 68% and 73% respectively, compared to 81% for last year. So, I mean, that's just, I think that's food for thought, and it just kind of shows you where we are currently with capital markets, IPOs, how people are allocating their funds.
Quite concerning statistics, really, for those. Just another thing to watch out for, isn't it?
Yeah, exactly.
And those can absolutely drag down the rest of the market as people have to sell those things to raise cash elsewhere. Yeah. So.
Yeah. Well, great stuff, gents. It was fantastic to get you both on the episode today. Thanks again for coming on. There was, plenty of food for thought throughout the episode. For those of you watching, if you guys enjoyed that episode, make sure you subscribe to our YouTube channel so you can stay on top of all the future What's on Your Mind episodes that we put out, as well as our other content. And also, don't forget that you can head over to our website to find out more as well. So we've got a bunch of events that we list up there. We've got a few coming up, a couple in April. We've also got, I think we've just published some details on a ITPM half-year conference that we're going to do. So there's details up on the website about that. You can also get your tickets there. Basically, all the senior trading mentors that you see on What's on Your Mind will be presenting on various trading topics at that conference. So it'd be really useful for you guys to learn from. And while you're on the website, of course, don't forget to check out the mentoring pages, because if you want to kind of learn how to develop trade ideas like these guys do on What's on Your Mind episodes, then you'll need to go through a mentoring program to do that. And there's lots of details about those, and you can apply to them on the website. But that's all I really wanted to go through today. It's been a fantastic episode. Thank you guys once again for coming on. I hope you all enjoyed it, watching it from home, and we'll see you again next week for another episode of What's on Your Mind.